FHA or conventional? It's the number one question I get asked as a mortgage broker. And here's the problem. Most loan officers will push you towards whichever one is easier for them to close than what's actually best for you. My name is Emmett Dempsey. I'm a mortgage broker here in Florida, and I'm going to break down FHA versus conventional in a way that actually makes sense. We're going to look at down payments, mortgage insurance, credit score requirements, and most importantly, which one saves you more money over the life of the loan. And if you're a veteran like me, I'm going to throw VA loans into the mix too, because that might blow both of these options out of the water. So let's go ahead and start with the basics so we're all on the same page. Let's get into it. All right, first the FHA loan. This is a loan insured by the Federal Housing Administration, or FHA. It's designed for first-time home buyers and people who might not have perfect credit or a huge down payment. So you can put down as little as 3.5% if your credit score is 580 or higher. And if you are under 580, you can still do FHA, guys, with 10% down. And a lot of people don't know that because most lenders won't do them. And as a broker, I have lenders that will. Conventional loan. This is a loan that's not insured by the federal government. It's backed by Fannie Mae or Freddie Mac, and you typically need a higher FICO score, and usually 620 or better, but really over 700 or more. And you can put down as low as 3%, though most people put down 5% or more. On the surface, they sound pretty similar, right? But the differences are where it gets interesting. So let's talk about down payments first. FHA, minimum of 3.5% if your credit score is 580 or higher, like I said. And if your score is between 500 and 579, you need 10% down. So for a $300,000 house, that's $10,500 at 3.5% or $30,000 at 10%. For conventional, it's minimum 3% down if you're a first-time home buyer. But realistically, most lenders want to see 5% unless you're a first-time home buyer using a special program. So for that same $300,000 house, that's $9,000 at 3% or $15,000 at 5%. So at first glance, conventional has a slight edge on the down payment. You can go as low as 3%, but here's the catch. If your credit score is below 620, conventional isn't even an option for you. FHA will work with you down to a 580 score, and in some cases even lower. So if your credit's not perfect, FHA might be your only choice. But let's keep going because this is where it gets more interesting. All right, this is a big one. Mortgage insurance. This is where FHA and conventional loans are very different, and it's where most people get tripped up. FHA mortgage insurance. You actually pay two types of mortgage insurance with an FHA loan. First, there's the upfront mortgage insurance premium, 1.75% of the loan amount. On a $300,000 loan, that's $5,250, guys. The good news is you don't have to pay that out of pocket. It gets rolled into your loan. The bad news is if you're financing it, you're paying interest on that extra for over 30 years. Second, there's the annual mortgage insurance premium, which gets divided into monthly payments. This ranges from 0.15% to 0.75% on your loan amount per year, depending on your down payment and loan term. See, most borrowers I deal with, they'll pay an annual MIP of 0.55%. On a $300,000 loan, then also $137.50 a month. I mean, that's an actual drop from where it used to be. It used to be over 1%. So things have come down in the FHA. And here's the kicker with FHA loans. If you put down less than 10%, that mortgage insurance stays on the loan for life. It never goes away. The only way to get rid of it is to refinance into a conventional loan later. Let's look at conventional mortgage insurance, PMI. With a conventional loan, if you put down less than 20%, you pay private mortgage insurance, or PMI. This typically costs between 0.5%, 1% of your loan amount per year, depending on your credit score and down payment. See, on that same $300,000 loan with 5% down, you're looking at around $125 to $250 per month in PMI. But here's the difference. With conventional loans, once you hit 20% equity, either by paying down the loan or the home appreciating in value, you can request to have the PMI removed by your lender. And by law, it automatically falls off at 22% equity. So with conventional, PMI is temporary. With FHA, if you put down less than 10%, it's permanent. So which one actually saves you money? Let's run the numbers. Let's look at the FHA scenario. 3.5% down equals $10,500. Loan amount equals $289,500 plus $5,250. Upfront MIP equals $294,750. Your monthly mortgage insurance equals $265. Your interest rate, let's say 6.25%, because FHA loans are lower because they are insured. Let's look at your conventional scenario. The 5% down equals $15,000. The loan amount equals $285,000. The monthly PMI equals $190. The interest rate, let's say 6.5%, because conventional loans are a little bit higher. In the short term, FHA looks cheaper because your down payment is lower. But when you factor in that lifetime mortgage insurance, conventional starts to win after about 5 to 7 years, especially if your home appreciates and you can drop the PMI. So here's the real question. How long do you plan on staying in the house? If you're buying a starter home and you plan to move in 3 to 5 years, FHA might be fine. If you're keeping your upfront costs low and you're not stuck with that mortgage insurance long enough for it to hurt. But if you're planning to stay 7+ years, conventional is almost always a better deal, assuming you can qualify. And also remember, you can always buy FHA, then refinance the conventional later if you want to stay longer. So you're not locked in any loan, you can always refinance out of it. So here's where credit scores come into play. So if you're below a 580, FHA is pretty much your only option. you'll need 10% down. If you're 580 to 619, FHA is still your best bet. And conventional loans typically require 620 credit score or higher. All right, 620 to 679, this is the gray area, guys. I mean, you can get a conventional loan, but your interest rate and PMI costs are going to be way high. And FHA could still be very competitive here. All right, 680 to 739. Conventional starts to pull ahead. Your rates and PMI costs are better, and you'll likely save money long term. All right, 740 plus. Conventional is almost always the winner. You get the best rates, the lowest PMI, and the flexibility to drop PMI once you hit 20% equity. If your credit score is above 680 and you can scrape together a 5% down payment, conventional is probably your better move. But if your score is below 620 and you're short on cash, FHA might be the only way to get into a home right now. Now, if you're a veteran like me or an active duty military, there's a third option that might beat both of these, the VA loan. And here's what makes VA loan special. 0 down payment. You can finance 100% of the home's value. No PMI, no upfront mortgage insurance premium, and VA loan rates are typically lower than FHA or conventional. So for that same $300,000 house, down payment, 0. Mortgage insurance, 0. Interest rate, usually 1/4 point to 0.5% lower than conventional. The only catch is a VA funding fee, usually 2.3% for first-time use with 0 down. On the $300,000 loan, that's $6,900. But just like FHA's MIP, you can roll it into the loan. Here's the kicker. If you have a service-connected disability rating of 10% or higher, the funding fee is waived. So you're getting a 0 down loan with no PMI and no funding fee. It's a pretty sweet deal, just like it should be for our military veterans. So if you're a veteran, VA loans are almost always the best deal. No contest. Okay, let's look at them side by side with a decision framework to make a best decision. Choose FHA. Your credit score is below 680, you have limited cash for a down payment, or you're buying a starter home and plan to move in a few years, or you can't qualify for conventional for whatever reason. You should choose conventional if your credit score is 680 or higher, you can afford 5 to 10% down, and you plan to stay in the home long term, like 7+ years. And you want the ability to drop PMI once you hit 20% equity. You should choose VA if you're a veteran or active duty military, you want 0 down with no PMI, and you qualify for the VA funding fee waiver with 10% or higher disability rating. You want the lowest rate and best terms available. Okay, and one more thing for my Florida buyers. I mean, property insurance is expensive here. I mean, flood insurance, windstorm coverage, higher premiums across the board. So if you're stretching to afford the house, I mean, those insurance costs can eat into your budget really fast. So going with a lower down payment option like FHA or VA might give you more cash cushion for those higher monthly insurance costs. I mean, it's just something to think about. Bottom line is there's no one-size-fits-all answer. The right loan depends on your credit, your down payment, your timeline, and ultimately your goals. And if you want help figuring out which loan makes sense for you, for your situation, go ahead and reach out, book some time on my calendar. I work with FHA, conventional, and VA buyers every day, and I can run the numbers with you. So go drop a comment, send me a message, and subscribe if you want more straight talk mortgage advice. Thanks for watching, and I'll see you on the next one.